Nvidia closed its last regular trading session on Tuesday, May 19, 2026, at exactly $220.61, marking an intraday decrease of 0.77%. While casual retail traders are frantically hitting refresh on their personal brokerage accounts across common platforms, looking at this sub 1% dip as a sign of normal pre-earnings exhaustion, the real narrative is happening entirely beneath the surface. Today is May 20th, and the collective focus of the financial world is fixed on the impending after-hours first quarter fiscal 2027 earnings release. If you peel back the layers of options positioning from the biggest desks on Wall Street, you see that institutional players are not looking at a standard quarterly report. They are quietly hedging for a historically massive $350 billion shift in equity value in a single night. This implied volatility skew means that the largest market participants are executing complex straddle positions, bracing for a swing that could instantly push this massive enterprise toward a $6 trillion valuation or trigger a cascading correction across the entire tech sector. The prevailing market belief is that as long as the revenue numbers look spectacular, the upward trajectory remains completely insulated. Investors logging into their individual brokerage apps see the stock up roughly 20% since the February report and assume the pattern will inevitably repeat. But that perspective completely misses the massive shift in buy-side expectations that has developed over the last 3 months. In reality, hitting the official consensus numbers is no longer enough to move the needle upward. The street expects $79 billion in total revenue, but the quiet whisper numbers on institutional trading desks are running well north of $80 billion. This huge gap between published forecasts and actual expectations creates an incredibly dangerous setup for anyone engaging in online investing without a deeper understanding of market psychology. If the company delivers a report that satisfies basic targets but fails to clear the whisper numbers, the institutional reaction could be a massive wave of distribution. If you track the daily swings and trading volumes over the past couple of weeks, the momentum has been anything but a straight line. After hitting an all-time high closing price of $235.74 in mid-May, the asset experienced a sharp 5.7% retracement before attempting to stabilize. This volatility is directly tied to the macro environment, where long-term bond yields are surging to fresh 52-week highs, putting significant valuation pressure on long-duration technology assets. When the 10-year Treasury yield climbs toward 4.68%, it changes the entire discounting model for high-multiple businesses. Experienced participants utilizing professional interactive brokers trading platforms are keenly aware that these macroeconomic pressures are forcing a structural reallocation of capital away from speculative names and directly into fortress balance sheets. Volume metrics indicate that institutional participation has remained highly concentrated, accounting for the vast majority of the 140 million shares changing hands daily. This brings us to the core technical structure guiding the asset right now. The stock is currently trading comfortably above its major moving average clusters, with the 20-day and 50-day simple moving averages sitting at $210 and $193 respectively. This alignment keeps the near-term technical trend firmly positive, providing a protective shelf for those practicing disciplined self-investing. However, the true test of this support will be determined by the gross margin commentary during the conference call. The consensus gross margin target is pegged at 74.5%, which aligns closely with management's internal guidance of 75%. Professional analysis indicates that any compression below 73% will be interpreted as a clear sign of pricing pressure as the newer product architecture begins to scale. Conversely, maintaining or exceeding 75% will confirm that incredible pricing power remains completely intact, which will move the equity much faster than a standard top-line revenue beat. Comment below how many shares of Nvidia stock you currently hold in your portfolio right now. To truly understand why the stakes are so high right now, we have to look closely at the primary engine of this enterprise, which is the data center segment. Wall Street is projecting data center revenue to hit approximately $73 billion for the single quarter. The overwhelming narrative among retail traders buying fractional shares on their mobile devices is that demand is infinite, but institutional analysts are hyper-focused on the physical limits of the global technology infrastructure. The primary bottleneck is no longer just the fabrication of silicon, it is the availability of fully powered data center shells, advanced liquid cooling infrastructure, and leading-edge high-bandwidth memory capacity. Major cloud providers are spending capital at an unprecedented rate, but they are increasingly running into the harsh reality of power grid constraints. This physical limitation means that the timing of massive hardware deployments is becoming highly variable, creating a direct conflict with the market's demand for flawless linear quarter-over-quarter growth. Furthermore, geopolitical polity risks are introducing a high-variance variable that the broader market is completely underestimating. The recent conditional clearance allowing export of advanced custom processors to select international technology firms has given bulls a fresh reason for optimism, with structural contractual cap set at 75,000 units per customer. Yet the actual implementation of these shipments remains completely dependent on complex licensing frameworks that can change at a moment's notice. Sophisticated investors using Interactive Brokers platform tools are carefully monitoring the 15% revenue share framework currently being debated in legislative circles. If tighter restrictions are enacted, it would instantly compress forward earnings estimates, leading to a sharp downward repricing. Management has intentionally excluded these volatile regions from their explicit long-term guidance, but any unexpected commentary regarding global trade friction could easily fracture the fragile sentiment holding up the current valuation multiple. If we step away from the immediate trading noise and look at what this business actually does, the underlying model is entirely centered on dominating advanced accelerated computing architecture. The company designs proprietary graphics processing units, central processors, and highly integrated networking systems that serve as the foundational fabric for modern high-performance computing centers. Their revenue model relies on selling these ultra-high-margin hardware stacks to hyperscalers, consumer internet giants, and sovereign entities looking to establish independent technical infrastructure. Over the past year, the transition away from older product lines toward the integrated Blackwell and Rubin computing platforms has completely altered the financial profile of the organization. Instead of merely selling individual silicon components, they are now delivering entire rack-scale systems complete with customized interconnects and proprietary software layers, making it incredibly difficult for customers to transition to competing merchant silicon or in-house custom chips. This structural lock-in is precisely why the historical financial reports look so staggering. Looking back at the full-year fiscal 2026 figures reported in late February, the enterprise brought in an astonishing $215.9 billion in total revenue, resulting in a net income of $120.1 billion. Those historical numbers show an organization operating at profit margins that are practically unprecedented for a massive hardware business. For context, the scale of capital appreciation this asset has experienced over the past calendar year is larger than the absolute valuation of some of the biggest brick-and-mortar retail corporations on Earth. This massive scale means that the company now commands an outsized influence over the broader indices, effectively dictating the direction of the entire market. When a single entity represents such a significant percentage of market performance, its quarterly update ceases to be an isolated corporate event and instead becomes a systemic macro catalyst. Looking forward into the upcoming quarters, this central tension will continue to be driven by the balance between massive free cash flow generation and the realities of capital allocation. Estimates suggest the business could generate well over $1 trillion in cumulative free cash flow over the next several cycles. How management chooses to deploy this capital will be a major structural driver for the share price moving forward. If a substantial portion of these funds is directed toward aggressive share repurchases, it will create a powerful structural floor for the equity, helping to offset any near-term multiple compression caused by rising interest rates. On the other hand, if the company continues to aggressively plow capital into minority investments in external software startups or specialized infrastructure plays, it could signal to the market that the core hardware business is preparing for an eventual normalization of the hyper-growth cycle, prompting a reevaluation of its long-term growth premium. When you synthesize the entire picture, the contrast between expectation and reality becomes incredibly clear. The market expects a flawless continuation of the historical trend, treating the business as an unstoppable force that can completely ignore macroeconomic headwinds and geopolitical friction. The deeper reality reveals an enterprise that, while incredibly dominant and profoundly profitable, is entering a much more complex phase of its life cycle. Growth is transitioning away from a pure volume expansion and becoming entirely dependent on execution efficiency, margin preservation, and navigating the physical constraints of global industrial power. Investors who rely on basic online investing advice often fail to see these shifting dynamics until they manifest as sudden, violent price movements. Success in managing individual portfolios over the coming year will require moving past the simplistic narratives and closely tracking the exact operational metrics that dictate long-term corporate health. In final analysis, the near-term direction of the equity hinges completely on whether management can deliver forward guidance that satisfies the aggressive assumptions built into current institutional models. For the upcoming quarter, the market is expecting forward revenue guidance to land somewhere between $85 and $87 billion, but clearing the true buy-side hurdle will require a forecast approaching $90 billion. If the company delivers that higher tier, it will completely validate the current premium and potentially pave the way for a historic run toward a $6 trillion market cap. However, if the guidance merely matches the baseline consensus, it will hand a powerful deceleration narrative to market skeptics, likely triggering a sharp retesting of key technical support levels near the $200 mark. Alternately, the illusion of an easy, predictable trend is fading, replaced by a sophisticated environment where understanding operational realities is the only way to protect capital. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Subscribe for more updates.